9:22 a.m. Eastern Thursday morning, COMEX silver futures just printed $50.12 per ounce, a violent 8% gap from Wednesday's close. The premium at major dealers hit £2.50 over spot. Backwardation sits at 18%, a structural impossibility that says near-term physical is worth more than future delivery. Refresh any major bullion site right now. Sold out. No ETA. The screen price looks stable compared to what's happening in the real world. Shanghai opened with a 420 premium over London spot. Arbitrage, the mechanism that's supposed to keep these markets aligned, has vanished. Dealer inventories that stood at 847 serialized bars Monday morning now show 1212. This is not normal volatility. This is the paper market trading against a physical reality it can no longer access. The divergence you're watching right now proves the system is breaking in real time. At 9:47 a.m. Eastern, the Shanghai Futures Exchange recorded silver trading at the equivalent of $54.30 per ounce, while COMEX futures still hovered near $50. That's a 10% gap between two markets that, under normal conditions, trade within pennies of each other. The arbitrage that connects these venues, buy cheap in New York, sell expensive in Shanghai, requires one thing: actual metal you can ship. Right now, that metal doesn't exist in sufficient quantity. Major refineries report allocation delays extending into June. The COMEX warehouse stocks dropped 340,000 ounces overnight, the largest single-day decline in 14 months. Physical buyers in Asia are paying premiums that make paper futures look like a different asset entirely. By the time New York fully opened, the spread had widened to 4 dealers. The system that's supposed to keep these prices synchronized just watched the gap explode and did nothing. Pull up the 1997 silver squeeze. Prices spiked to $7 or $80 before collapsing when physical supply finally met paper demand. Now compare. 2008 saw brief backwardation during the financial crisis, resolved within days as systemic liquidity returned. Post-2021, regulatory changes tightened margin requirements and reduced leverage across commodity futures. Those changes were designed to prevent excessive speculation. They also reduced the liquidity cushion that once absorbed shock. Today's market operates with thinner buffers, tighter inventories, and far less tolerance for divergence. The current spread isn't behaving like 1997's brief dislocation or 2008's liquidity freeze. This one's widening while inventories drop and premiums climb simultaneously across 3 continents. The historical precedent says these gaps close. The current data says the mechanism that normally closes them has stopped functioning. The system can't hold this imbalance indefinitely. Every hour it persists increases the probability of forced settlement at prices nobody anticipated. By 10:12 a.m. Eastern, the crisis had shifted from price shock to mechanism failure. COMEX showed relative calm, futures trading in a tight range, options activity normal, volatility elevated but contained. Toggle to any major dealer site. American Gold Exchange posted allocation delays, serial numbered product unavailable. SD Bullion's homepage read inventory extremely limited, expect shipping delays. JM Bullion showed green bars struck through with out of stock across every popular silver product. The paper market was pricing silver as if supply existed. The physical market was screaming the opposite. This isn't a temporary liquidity crunch. Dealers sitting on multi-week backlogs don't happen because of short-term demand spikes. They happen because refineries can't produce fast enough and wholesalers can't source metal. Meanwhile, arbitrage traders who normally buy COMEX futures and take delivery to sell into high-premium physical markets were nowhere. The spread that should attract instant capital sat untouched. The real metal had already disappeared. 10:37 a.m. Eastern. Shanghai physical premiums widened to 5.10 over London spot. That's the price Chinese buyers were willing to pay for metal they could actually hold. COMEX futures, theoretically backed by deliverable silver in approved warehouses, traded $5 lower. The divergence exposed a brutal truth. Paper contracts promise delivery, but delivery requires inventory, and inventory was evaporating. Asian dealers reported premiums climbing hourly. A Hong Kong-based bullion platform posted, limited allocation available, orders processed in sequence received. Translation: even if you pay the premium, you're in a queue. Physical scarcity doesn't care about your futures contract. While Western screens displayed orderly trading, Eastern markets were experiencing something closer to a run. The gap wasn't closing because the mechanism designed to close it, arbitrage buying in the cheap market, selling in the expensive one, required moving actual metal across borders. Right now, nobody could source enough to make the trade worth the execution risk. This is where it gets dangerous. Futures contracts exist in 2 states, cash settled or physically delivered. Most traders assume they'll cash settle, close the position, take profit or loss in dollars, move on. But when backwardation hits 18% and physical premiums explode, some contracts flip to delivery intent. Shorts who sold futures expecting to buy them back cheaper suddenly face a choice: deliver metal they don't have, or buy it in a market where premiums are spiking. By 11:02 a.m. Eastern, COMEX reported a 22% increase in delivery notices for the active contract month. That's traders saying, I want the actual metal, not a cash equivalent. Every delivery notice forces a short to either locate physical silver or negotiate a cash settlement at whatever price the long demands. In a normal market, that's manageable. In a market where dealer inventories dropped from 847 bars to 12 in 3 days, it's a trap with no exit. Lease rates, the cost of borrowing physical silver for short-term delivery, jumped from 0.4% to 3.1% overnight. That's the market pricing in scarcity. When lease rates spike, it signals that anyone holding physical metal can demand higher returns just for lending it out temporarily. Shorts who need to deliver can't find metal to borrow. The math becomes brutal. Borrow at 3.1% annualized or buy outright at a $5 premium and risk the premium widening further. Meanwhile, COMEX warehouse stocks dropped another 180,000 ounces by midday. Registered inventories, metal available for delivery against futures contracts, now sat at multi-year lows. The squeeze isn't theoretical, it's mechanical. Every ounce withdrawn from COMEX registered stocks reduces the pool available to satisfy delivery obligations. Every lease rate increase makes it more expensive to delay, and every hour the premium stays elevated, more longs decide they'd rather have metal than cash. The pressure builds in one direction, higher. Pay attention to what's not happening. Arbitrage should be instant. COMEX at $50, Shanghai Physical at $55, spread equals $5. Buy New York, sell Shanghai, pocket the difference. Except that trade requires 1. Buying futures, 2. Taking delivery from COMEX warehouses, 3. Shipping to Asia, 4. Selling into the premium market. Right now, step 2 is broken. COMEX warehouse inventories can't satisfy the delivery demand already in the queue, let alone absorb new arbitrage flows. Shipping times from U.S. warehouses to Asian dealers run 3 to 5 weeks under normal conditions. In a market moving this fast, the premium could collapse or widen further before the metal even arrives. The arbitrage opportunity sits there, flashing on every screen, untouched. It's untouched because the traders who'd normally take it understand the execution risk has become unmanageable. That's how you know the market isn't functioning. The free money is going unclaimed. By 11:45 a.m. Eastern, the narrative expanded beyond pure market mechanics. Central banks in multiple jurisdictions had been quiet buyers of gold for 2 years, a documented trend. Silver, while not a reserve asset, trades in parallel during monetary stress. Currency devaluation fears were rising across emerging markets. Geopolitical blocs were tightening commodity supply chains. None of this was speculation. These were observable policy shifts. Now layer that onto a silver market already experiencing inventory collapse and premium explosions. If nation-states or large institutions decided silver was a strategic hedge, even modest buying would overwhelm remaining supply. The COMEX system, designed for financial speculation and commercial hedging, was never built to handle a run driven by monetary fear. The paper market could handle infinite speculation. The physical market couldn't handle 3 weeks of sustained institutional demand. And the data said that demand was already here. 11:58 a.m. Eastern, futures hit 52.40, another leg higher. But focus on the spread. COMEX to Shanghai Premium now measured 6.30. Dealer sites across North America, Europe, and Asia showed identical messages: limited inventory, allocation delays, no ETA on restocking. This wasn't a regional shortage. This was global. The mechanism that connects paper pricing to physical reality, warehouse inventories available for delivery, was demonstrating structural failure. Registered COMEX stocks dropped below 30 million ounces, the lowest level since early 2021. Commercial shorts, the entities who sold futures as hedges against their physical inventory, were now facing margin calls on contracts they couldn't easily cover. If they held the physical metal, they could deliver. If they didn't, if they'd sold futures as pure financial hedges, they were trapped in a rising market with obligations they couldn't meet, except through cash settlement at prices climbing faster than their risk models had projected. Here's the nightmare scenario for paper holders. You own a futures contract bought at $48. Silver hits 55s, you're up $7 per ounce, you go to take delivery. The broker informs you, warehouse inventory insufficient, cash settlement required, you're paid $55 per ounce. Except physical silver, the metal you thought you owned the right to receive, is trading at $60 on dealer sites because of the premium. You just got paid $5 less than the real-world price. Now imagine you're a short. You sold at $48, expecting to buy back at $45. Silver hits $55. You're down $7 per ounce. The long demands delivery. You don't have physical metal. You're forced to cash settle at $55 or buy metal in the physical market at $60 to deliver. Either way, you're paying more than the futures price said you would. That's the trap. Paper promises a price, but delivery happens in the physical world where different rules apply. By 12:01 p.m. Eastern, silver futures touched 57.20, a level not seen since the brief 2021 spike. The premium over COMEX registered stocks now implied that physical buyers valued immediate possession at $8 above the futures price. ETFs backed by physical silver reported net inflows, meaning investors were buying shares expecting those shares represented real metal in a vault somewhere. But ETF inventory doesn't sit in COMEX warehouses available for futures delivery. That metal is allocated to the fund, not the exchange. The divergence between silver you can claim and silver available for delivery against futures was widening. Options traders were pricing in further volatility. The term structure, future contract months, showed backwardation extending across the entire curve. That's the market saying near-term silver is more valuable than future silver, and that condition isn't temporary. The system no longer believed its own forward pricing. The curve was screaming shortage. 12:30 p.m. Eastern. Do the math. Global annual silver mine production, approximately 830 million ounces. Industrial demand, roughly 520 million ounces. Investment demand, variable, but 2021 saw spikes above 250 million ounces during retail squeezes. Jewelry, silverware, other uses, another 200 million. The market was already tight under normal conditions. Now add potential central bank buying, institutional hedging against currency risk, retail FOMO from rising prices, and existing shorts scrambling to cover. Supply is inelastic. You can't mine faster on demand. Inventories are finite and dropping. Refineries operate at capacity and can't instantly scale. Every ounce of new demand has to come from either reduced industrial use or seller liquidation. Right now, sellers weren't liquidating. Premiums rising means holders are waiting for higher prices. And industrial users can't cut consumption without shutting down production lines. The math says prices must climb until demand destruction occurs or new supply appears. Neither is imminent. 1:02 p.m. Eastern. The spread that opened at 0.90 this morning between COMEX futures and Shanghai Physical now measured $8.40. Dealer inventory that started the week at 8.47, serialized bars dropped to single digits across multiple tracked platforms. Premiums that were considered high at $2.50 had doubled. Lease rates that signal borrowing costs for physical metal sat at levels not seen outside of crisis periods. The backwardation that opened at 18% had widened. Every signal that indicated abnormal market stress at the opening bell had intensified. The system designed to arbitrage these gaps, buy cheap, sell expensive, profit from the difference, had failed to materialize because the physical metal required to execute the trade no longer existed in accessible form. The paper market could create infinite contracts. The physical market had run out of deliverable ounces. That divergence, documented across every venue and every data point, proved the squeeze was real and continuing. Watch the registered inventory number. When it hits zero, the entire structure breaks.